New tax regulations on investment income for Canadian-controlled private corporations in 2019. Hi, I'm Sarah from Filing Taxes, your trusted tax partner. From meticulous deductions to seamless filings, consider your tax needs handled professionally with our team of experts. In today's video, we will be looking at the new rules introduced for Canadian-controlled private corporations, CCPCs, by the Canadian government in 2019. The Canadian Liberal government has implemented new tax regulations effective from 2019 concerning the taxation of investment income earned by Canadian-controlled private corporations, CCPCs. This video is specially tailored for Canadian business owners who invest through their companies. Let's talk about passive investment income. Passive investment income encompasses dividends, interest, capital gains, and royalties. Canadian companies commonly allocate their surplus funds to passive investments such as real estate, stocks, bonds, and mutual funds to yield a reasonable return on their capital. The Government of Canada has introduced new rules applicable from 2019 that impact the taxation of this income. Under the previous regulations, Canadian-controlled private corporations were subject to a 50% tax rate on investment income. Certain types of investment income, like capital gains, enjoyed a lower tax rate of 25%, which remains unchanged. What has changed is the tax rate applied to corporate business profits generated from day-to-day operations by a CCPC when those profits are reinvested in passive investments. Now, let's delve into the details of the new rules for the Canadian corporate taxation of investment income using an example. Blueprints Express Inc., a CCPC with a sole owner named David, invested $1 million of its savings into a passive investment, earning $80,000 in 2019. Additionally, Blueprints Express Inc. made $300,000 in profits from its main business in the same year. While the tax rate on passive investment income remains at 50%, the tax rate on the business income has increased from 13.5% under the old rules to 21.8% under the new rules. This change is attributed to a tax law passed by the Liberal government effective from 2019, imposing a higher tax rate on the business income of a CCPC when the corporation earns over $50,000 of passive investment income in the year. Essentially, CCPCs are being penalized for accumulating substantial cash reserves and investing those funds in passive investments. CCPCs can claim the small business deduction on business profits up to $500,000, reducing the tax rate to 13.5% on those profits. However, for every dollar of passive investment income earned by a CCPC over $50,000, the small business deduction limit is reduced by $5. Once the passive investment income reaches $150,000, the small business deduction is eliminated. Applying these rules to Blueprints Express Inc., which earned $80,000 of passive investment income, $30,000 over the $50,000 threshold, the small business deduction limit is reduced by $150,000. After the reduction, the small business deduction limit becomes $350,000. The business taxes of Blueprints Express Inc. are impacted as follows. The initial $100,000 of business profit earned by Blueprints Express Inc. will be taxed at 13.5%, consistent with both old and new rules. However, the subsequent $50,000 business profit earned by Blueprints Express Inc. will now be taxed at 26% under the new rules compared to the previous 13.5%. The total taxes payable by Blueprints Express Inc. on its business profits of $350,000 come to 21.8% under the new rules, in contrast to the 13.5% under the old rules. If you're looking to get a tax advice on how to manage your investments through a corporation, feel free to reach out to Filing Taxes, and our professional accountants will take care of all your tax needs. Email us at tax@filingtaxes.ca or give us a call at 4164 798 532. Thank you for watching.